Welcome to my 2-minute take on what we're calling our assets in reserve funds. Now, assets in reserve are often referred to as a cash reserve, although it's really important to know that this isn't just cash, and there are more investments and more risk involved than just cash investments. Why do we have assets in reserve? Well, we generally are looking to hold 1 to 2 years of living expenses or regular commitments, some emergency cash if you need it, and dry powder which is funds that you've set aside for opportunistic investment down the track. The purpose of this portfolio and the mix of funds in this portfolio is not to generate income. This is generated by your long and your medium-term investments. Rather, it's to hold the cash that you've already generated for your cash flow needs in a safe and stable holding pen. It deals with sequencing risk. This is the risk that the timing of your investment returns are unfavourable when you're drawing on your capital. How have we chosen the funds? I've listed 5 reasons there: liquidity, stability of capital value, low or nil transaction costs, ideally low correlation to equity risk, and very low manager risk. The first fund is the Mutual Cash TD Fund. It holds short-term term deposits with the major APRA-regulated Australian banks. Think CBA or Westpac. It's more practical and efficient than individual term deposits, which you have to select and reinvest in each time. The expected average return is about 0.6% above the RBA cash rate, and there are no negative months. It has a fixed unit price. The next fund is the Daintree Core Income Trust. It holds high-grade floating rate Australian bank and corporate debt securities. Its expected return is about 1.6% above the RBA cash rate and has rare negative months, about 1 every 2 years. The third fund is the Trilogy Enhanced Income Fund. 1/3 of it is invested in their mortgage fund, which lends to repeat residential real estate developers, not mums and dads buying homes. 2/3 is invested into the high-grade floating rate debt funds that are similar to what we have in our portfolio. The expected average return is about 3% above the RBA cash rate. It has a 1 month notice period. But the really important thing to understand about this fund is while it has no negative months because it's got a fixed unit price, the risk is that they can either extend the notice period, which they did last year, to 3 months, or freeze the fund. So it's not a fund that we put in money that we're going to need unless we're looking at perhaps a 12-month period before we're going to need the funds.